Good day, Junior Tickies. I'm Mrs. Brimacombe. We're going to look at Activity 5. Statement of Financial Position. You are provided with the information from the financial records of Yummy Bakery, a partnership between Tumelo and Masego. Required, prepare the following notes to the Statement of Financial Position, the capital account and the current account. Complete the Statement of Financial Position. So if we look at the information, it's an extract from the trial balance on 30 April 2022. If our accounting period ends 30 April 2022, it means it starts the 1st of May 2021. Always know, when does your accounting period end? When does it start? Now, if you also look now at what is the information given here, current account in brackets, it says 1 May 2021. That means that's the beginning of your accounting period. They provided you then with the adjustments. Now, when completing this, we always start with the figures from the pre-adjustment trial balance. Remember, this must appear in your financial statements. You cannot just leave it out if there were no adjustments to any of these figures. Your step number 1 is show where this is supposed to go. Starting with question 5.1, notes to the statement of financial position, the capital and the current account. From the pre-adjustment trial or from the list of balances given, they said to you current account Tumelo and Masego on the 1st of May 2021. Tumelo had a credit balance and Masego had a debit balance. So that's your step number 1. We can immediately take those figures. The current account, the balances in the beginning is your retained income in the beginning. Credit means positive, no brackets. Debit means negative, so it must be shown in brackets. To get the total, plus minus equals. Now don't just rush and write the capital balances down in the beginning. You always need to look at your adjustment. What does it tell you about capital? Was there any movement? Did one of the partners decide to contribute more capital, or did one of the partners decide to withdraw some of their capital? Both could have contributed more or could have taken from their capital. So if we look at the interest on capital, what does it say? Interest on capital is provided for at 15% per annum on capital balances. Partner Tumelo decided to decrease her capital contribution by 200,000 on 30 November 2021. This was recorded. That is key words written there. This was recorded. Partner Masego remained the same throughout the year. Now, because this was recorded, the 200,000, my advice is always start with the movement. Tumelo decided to decrease her capital contribution. Withdrawal of capital, 200,000. Because this has been recorded, it means the balance from the pre-adjustment trial or the list of balances given, that 400,000, is the balance at the end, which means you need to work out the balance in the beginning. Because she decreased her capital, the balance in the beginning is more. It's opposite calculation. When you work your way up, we need to add. Now, at the same time, interest on capital is calculated on the capital balances, which means we need to work out the interest for Masego. Sorry, not for Masego, for Tumelo. They provided the interest on capital for Masego, that was 112,500. My accounting period starts the 1st of May 2021 and it ends 30 April 2022. So if the interest on capital is calculated on the capital balances, we cannot calculate it for 12 months on 600,000 and 12 months 400,000. there was movement during the year. So this is my approach. I'm going to start with the balance, capital balance in the beginning was 600,000. They decided to decrease, or she decided to decrease her capital on 30 November, which means I need to calculate for 7 months on 600,000 from May until November is equal to 7 months. Then I'm going to calculate from December until April, which is equivalent to 5 months. I'm going to calculate 15% on 400,000. And the two added together is the total interest on capital. You need to make sure that you get this 100% correct. That capital balance, when it says this was recorded, otherwise you're going to calculate your interest incorrectly. The total interest on capital for Tumelu is 77,500. Masego was given 112,500. So the two added together is the total interest on capital. Now, take note, capital of Masego is a question mark. They provided the interest on capital for Masego, and they said partner Masego remained the same throughout the year. So the capital balance was exactly the same from the beginning until the end. This means we need to solve that capital balance. To find out the interest, we would have taken the capital amount times 15 divided by 100 equals interest on capital. So the capital amount becomes now x. So it's a case of solving x. So to solve x, we need to say 15x divided by 100 equals 112,500. So to get x alone, it equals 750,000. There were no movement, which means that the balance in the beginning is the same as the balance at the end, which we calculated 750,000. Now we can finish the capital account note by adding Tumelu in the beginning plus Masego equals the total balance at the beginning of the year. There were no additions. The total withdrawal of capital, 200,000. Now, if you take the beginning minus, it should give you exactly the same answer if you add the two balances at the end. Salaries. Monthly salaries are included in the balances of the drawings account of the partners. Each partner received a monthly salary. In this respect, Tumelu has withdrawn her full annual salary of 350,000, while Masego has withdrawn 420,000, which included her salary for May 2022. Salaries increased by 20% per annum effective from the 1st of January 2022. So this is a little bit more complicated. So where do we start? The easy mark here. Tumelu, they've provided, she withdrawn her full salary, 350,000. So we're going to say partner salary, Tumelu, 350,000. Now Masego withdrawn 420,000. This included her salary for May 2022. Now that is not a problem. It will form part of the drawings. But when we show the partner's salary, it's the salary per annum, which is equivalent to 12 months. So now I can't just take 420,000 and divide it by 13. To find the monthly salary, 1 month must be taken out to show the partner's salary allowance for 12 months. Why? Because from the 1st of January, the salaries increased by 20%. This means now from May until December, the salary was for 8 months at 100%. From January until April, it was at 100 plus 20%. But remember now, this partner took her salary, Masego took his salary 1 month in advance. That's basically what he's done. He withdrawn his salary for May 2022. This means now to find out the monthly salary, there's two methods. Method number 1, we're going to say 100 times 8 equals 800. Then we're going to say 120 times 5 from January until May is equivalent to 5 months. That equals 600. So I want to know what is the monthly salary. So 420,000 times 120 divided by 1,400 equals 36,000. 420,000 minus 36,000 means that the salary allowance was 384,000 for Masego for this accounting period. This was what the partner was entitled to per annum. If I add the two salaries, that equals the total partner's salary. Method number 2 is when we're using X. Then we would say 8x plus 5x times 120 divided by 100 equals 420,000. When using X, this will provide you with the figure before the increase. Then we still need to work out what is the amount after the increase. So keep that in mind. And again, it doesn't matter how we get to the answer as long as we get to the same destination. Use what method works for you. Remaining income. Each partner received 40,000 being their share of the remaining income after providing for the partner's salary and interest on capital. This indicates that there were no bonuses given to any of the partners, which means that we can calculate now the primary distributions of profits by taking partner salary plus interest on capital for each partner, and then we can calculate the total. So if I add those two together, it should give you exactly the same answer if you take the partner's salary plus interest on capital. So they said now each partner received 40,000 being their share of the profit remaining income. That is our final distributions of profits. Each partner is getting 40,000, so the total is equal to 80,000. To calculate the profit per income statement, we have to take primary distributions of profits plus final distributions of profits for each partner, and that equals now the total profit per income statement. If you look now at drawings, don't just go and write the totals that were given to you in the list of balances as the total drawings for the year. You first need to look at, was there any additional drawings or an adjustment to drawings? Now refer to adjustment number 2. The asset disposal account has not yet been completed. The entries which have been put through asset disposal, so they've taken out the cost and they've taken out the total accumulated depreciation. These entries are in respect of equipment sold on 31 January 2022. The depreciation rate on equipment is 10% per annum on cost, but the bookkeeper had depreciated the asset for the entire year instead for 9 months. Correct the error. The equipment was taken over by partner Tumelo at book value. This was not recorded. So they've done step number 1, 2, and step number 3. What they haven't done is they haven't done step number 4, record the selling price, And in this case, it was taken over by the partner to Melu. So this must be added to his drawings. Step number 5, calculate the profit or the loss on the sale of the asset. Remember now, we're only doing statement of financial position. So profit or loss will go in the statement of comprehensive income, which was not required. What is now very important to understand? Equipment, 150,000 accumulated depreciation on equipment is after those steps occurred. Asset disposal, 13,600, and the depreciation, all of this has been done by the bookkeeper, but it was done incorrectly. If you take 34,000 minus 20,400, it equals the 13,600. Depreciation was calculated for 12 months instead of 9 months. So we just need to correct that error, and then again we need to show that the partner has taken it over at book value. So if we draw now our T accounts, in this case it's much easier opening up T accounts to understand what is happening. That 150,000 is after the 34,000 has been taken into account, which means that the balance in the beginning was 184,000. Accumulated depreciation, the 105,000 was after the accumulated depreciation. The total on the asset which we've disposed of was taken out, which included the balance in the beginning plus the updated depreciation on the asset which we sold, which was calculated incorrectly. So it means that the balance was in the beginning, before all of this, 122,000. It's important to understand what happened so that you know how to correct the mistakes. Depreciation had a total brought forward, 3,400. This was the updated depreciation on the asset which we disposed of. Asset disposal, 13,600 as a total brought forward. This is after step number 1, the cost was taken out. Step number 2, the depreciation was updated. Step number 3, the total accumulated depreciation was taken out to the asset disposal account. Because depreciation was calculated on 12 months and it should have been 9 months, we're just going to correct that error by now calculating, because it was calculated on cost, we are going to take the cost, which is 34,000 times 10% times 3 divided by 12. So 850,000 must be taken out. Depreciation will be credited. Accumulated depreciation will be debited. Remember that we are correcting the mistake that happened. This means that my asset disposal account must also be corrected. Asset disposal will be debited with 850 and accumulated depreciation will be credited with 850. Now this equipment was taken over by the partner at book value, which means there's no profit or no loss. So to get the book value, we are going to take the total brought forward, 13,600 plus 850, and that is the total drawings. That must go to your current account. This will be added to the drawings of Tumelu. Now, while we're busy with this adjustment, before we're going to take that drawings to the current account, we're going to solve the depreciation. We still need to calculate the depreciation on the old, because it says there, provide for depreciation on equipment at 10% per annum. So when we're looking at the old, the remaining, we're going to take the 150,000 times 10%. This 150,000, reminder, is after the equipment was sold. So that is your remaining balance. So you're simply going to say times 10%. We'll go back to this once we complete the statement of financial position. First, let's complete the current account. In my current account, I'm going to have now drawings for Tumelu. The total drawings, 390,140. There were no changes with drawings with Masego. That was 422,500. The total drawings of both partners added together, and it must be in brackets. Now we can calculate our retained income for the year. To calculate the retained income for the year, it's your profit per income statement minus your drawings for each partner to get then the retained income at the end. So while we're calculating the retained income for the year, we immediately add the retained income at the beginning because it was no brackets. That equals the retained income at the end. For Masego, we're going to take profit per income statement minus drawings equals the retained income for the year minus the retained income in the beginning. To get the total, we can now either add each partner or we can take the profit per income statement minus drawings minus, because that is in brackets, the retained income at the beginning. That equals 181,000. If I add those two together, it should equal exactly the same answer. Now, do not forget the total balance at the end of the year for capital and the total retained income at the end of the year for the current accounts must appear in the statement of financial position. Completing the statement of financial position, we start with the list of balances which was given to us. Fixed deposit, make sure that you write the name, Sanlam. You should know that the capital, owner's equity, consists out of capital and current account, and non-current liabilities consist out of loan. Then we're going to write what has been given to us. They provided to us the fixed asset or tangible asset. They said land and buildings. You should know land and buildings forms part of note number 3, the tangible assets. So we've got land and buildings plus equipment minus accumulated depreciation on equipment. Fixed deposit, Sanlam, 315,000 in brackets. Inventories consist out of your consumable stores on hand, 5,805, and your trading stock. So they provided the trading stock, 248,635. This is the easy marks to get. Trade and other receivables will always consist out of your trade debtors, which was given to you. Net trade debtors, 123,000, minus the provision for bad debts adjustment, and prepaid expense will always form part of your trade and other receivables, 8,500. Cash and cash equivalents will always consist out of your cash float, petty cash, bank, but here take note, they said bank overdraft. If it's a bank overdraft, it goes to your current liabilities. Trade and other payables will always consist out of your creditors control. So again, this is the easy marks to get, knowing where am I supposed to take all these balances. Adjustment number 1. During a burglary at the shop, money from the cash float was stolen. The insurance company will cover 80% of the total loss, but this has not yet been received. Total loss made was 400. No entries have been made. So what needs to happen here? First, we need to show that money was stolen from the cash float. The original amount must be taken from the cash float, which means cash float will be credited and and loss due to theft is going to be debited. But now they provided you with the total loss made was 400. So if I want to know what was the original cost of the cash flow that we lost, the original amount, we have to take times 400 times 100 divided by 20. Why? Because 80% of the total loss is what the insurance company is going to pay us out, which means 20% is our loss, which was equivalent to 400. So that's important to understand. Now, what the insurance company is going to pay us out means it needs to go to accrued income, and accrued income forms part of your trade and other receivables. Two options now. You can take 400 times 80 divided by 20, or 2000 minus 400. It gives you exactly the same answer. Accrued income will now be added to trade and other receivables, 1,600. Cash and cash equivalents, we need to show minus 2,000 because of the cash float, which was stolen. Now with adjustment number 2 and 3, which we've already covered, but just to make sure that you understand, accumulated depreciation, we needed to adjust that. There was nothing wrong with the cost, so the equipment is going to stay the same. The equipment at cost. But when we get to the accumulated depreciation, it's your balance brought down after the asset has been disposed of. But then we needed to make a correction. We needed to add 850 and minus 850. And we needed to include the depreciation on the remaining assets. So this means that we are going to indicate minus 15,000. That plus minus, that 850 will basically cancel each other out if you think about it, if you see the T account. So we still need to account also for the depreciation on the remaining assets. If you actually think about it, just to go back 1 minute, if we've calculated for 12 months and it should have been 9 months, we've actually overstated the amount, the depreciation that was calculated. The book value on the asset which we've disposed of was also calculated incorrectly. The next adjustment, a debit balance of 8,000 in the creditor's ledger must still be transferred to his account in the debtor's ledger. If you make a change to the ledger, you need to make a change to the control account. Now, this is one adjustment which learners often battles with. So if you're not sure, do a quick T account and just make sure you get it 100% correct. Because many of the times you 100% write the amount correctly, I should add or subtract 8,000, but we actually show the influence it will have on that balance incorrectly. For example, now here, a debit balance in the creditor's ledger must be taken to the debtor's ledger. So if we need to take it out, we're going to credit the creditor's control account. And to credit it, we will plus 8,000. Debtor's control will now be debited. And if debtor's control is debited, we're going to add 8,000 to trade and other receivables. So yes, I need to take it out, but by taking it out doesn't mean minus. By taking it out, it had a positive effect on the creditor's control and on the debtor's control. Make sure that you get it right. Take that extra 10-20 seconds and draw a T account. Next adjustment, the following items are reflected in the bank statement for April 2022. Direct transfer from a tenant, 26,200. Direct transfer from the tenant means that money was received. But now you need to remember, we had a bank overdraft. So, when there's a bank overdraft, when the business receives money, bank will always be debited. When a payment is made, bank will be credited. But if bank is debited and we have an unfavorable bank balance, this means that our liabilities will decrease because the business received money. Then paid 16,300 to fast deliveries for transport of merchandise. So if a payment was made, bank will always be credited. You need to know now, deliveries for transport for merchandise means that this must be added to the trading stock account. So bank is going to be credited, trading stock is going to be debited. So when we're completing our statement of financial position, we're going to have minus 26,200 for the rent income, plus 16,300 for the trading stock, and we need to take it to our inventories and add 16,300. Next adjustment, interest for April 2022 on the loan from Nedbank has not been recorded. The interest is capitalized. The mortgage loan is expected to decrease by 36,000 in the next financial year. So if we look now at our loan, we start with a balance of 420,000. Interest is capitalized, which means it's added to the loan account. So to calculate the interest, it says interest for April is outstanding, which means we need to calculate for 1 month. So 420,000 times 15% times 1/12 equals my interest, which should be added to the loan account. Now, this is the part where learners get it wrong. The mortgage loan is expected to decrease by 36,000 in the next financial year. Whatever is paid in the next accounting period must be taken out of our long-term liabilities and taken to our current, which means we're going to take, if 36,000 is paid in the next 12 months, this will go to your current portion of loan, and the difference will be your non-current liabilities. So on my statement of financial position, we are going to add the interest, 5,250 minus 36,000, and that goes to the current portion of loan or short-term loan. Now we've done all the adjustments. We need to now take capital, the total capital, and the total current or retained income at the end of the year. The total goes to the statement of financial position. Once we've done with that, we've done now all the list of balances. We've taken it where it's supposed to go. We've done all the adjustments. Now we can finish off the statement of financial position by closing off the brackets. Starting with your tangible assets note, plus the fixed deposit equals my non-current assets. Inventories plus trade and other receivables plus cash and cash equivalents equals my total current assets. To get my total assets, we have to take our non-current assets plus current assets equals total assets. You should know that your total assets must be equal to your total equity and liabilities. Now, if we take our capital plus our current account, it equals our total capital and reserves or owner's equity. Loan there was only the loan from Nedbank, so our total non-current liabilities. Next, calculate your current liabilities. Add your trade and other payables, plus the bank overdraft, plus your current portion of loan. That equals your current liabilities. If you now take your owner's equity plus non-current liabilities plus current liabilities, it should give you exactly the same answer. We have now looked at different ways in which statement of comprehensive income and statement of financial position can be asked. Now, what we haven't done is we haven't looked at when financial indicators is given to you and you need to find missing figures completing your financial statements. In our next chapter, when we look at financial indicators, then we're going to look at activity where financial indicators is given to you and you need to complete your statement of financial position or statement of comprehensive income. Thank you very much. Believing in yourself is the first secret of success.